Welcome back. Today, we're going to play financial detective and solve a pretty cool puzzle about a convertible bond. We've got a few key clues, and they all point to one and only one unavoidable conclusion.
So here's how we're going to tackle this. First, we'll look at the case file. Then we'll find the key that unlocks the whole thing, run the numbers, rule out the red herrings, and finally, crack the case.
Okay, first things first. Let's open up this case file and see exactly what we're dealing with when it comes to this Lapid Company bond.
All right, so here are the facts of the case. The company is Lapid, and we're looking at one of their convertible bonds. The date is May 31st, 2011. Now, the stock price? It's sitting at 9.25 shekels. The conversion ratio is a whopping 750%, which, just means 7.5. But here's the real kicker, the most important piece of evidence. We have to assume the market is efficient and has high volume. So that's all the info we've got. The big question, the mystery we're here to solve, is what has to be true about the bond's price? What's the one thing we can say for sure? Let's figure it out.
Okay, so to crack this case, we need a secret weapon. And that weapon is understanding a concept called the conversion premium. This is the key that unlocks everything. So what is it? Well, think of it like this. It's the extra cash an investor pays for the option to convert that bond into stock later on. You're basically paying a little extra for the potential upside, for the flexibility to jump on a rising stock price. It's the price you pay for a good what if.
And, of course, there's a formula for it. This is what connects all the dots. You see how it links everything together? You've got N for the conversion ratio, PB for the bond's price, and PS for the stock's price. This little equation, this is our roadmap. Now here's where that efficient market clue comes in. In an efficient market, there's no free money lying around. Just doesn't happen. If this premium ever went negative, well, that would be a literal free money opportunity, an arbitrage. Traders would jump on it in a nanosecond, buying the bond, converting it, selling the stock for an instant risk-free profit, and all that action would immediately snap the prices back into place. So, the bottom line? That premium has to be 0 or higher. It can't be negative, period.
All right, enough theory. It's time to do the math. Let's take this logic, grab our formula, and plug in the numbers from the case file.
It's actually pretty straightforward. First, we start with our big rule. The premium has to be greater than or equal to 0. Then we just drop our formula in there. Step 3, we plug in the numbers we know, 7.5 for N and 9.25 for the stock price. And from there, it's just a little bit of high school algebra, right? We just move things around to solve for the one thing we don't know, PB, the price of the bond.
And voila! Look at that. The math tells us, clear as day, that the bond's price, PB, has to be greater than or equal to 1.2333 shekels. If it were any lower, you'd have that free money situation we talked about. This is our breakthrough, our first really solid piece of evidence.
Okay, so now we have a solid lead. The price has to be over 1.2333. With that in our back pocket, let's look at our lineup of suspects, the possible answers, and see which ones we can eliminate. Let's look at this first claim. All remaining bonds will be immediately converted. The word all is a huge red flag. Can we really say what every single investor is going to do? No way. Some people might just want to keep the bond and collect the coupon payments, so we can't prove this one. It's out. Okay, next suspect. The bond is trading at a negative yield. The problem here? We just don't have the data. To figure out the yield, you need the coupon rate and the exact current price. We don't have either of those in our file. So this is pure speculation. We have to throw it out.
And this next one is basically the same story. The bond price is lower than its adjusted value. Again, how would we know? To find the adjusted value, we'd need its yield or its exact price, information we just don't have. So this one's a no-go too, another dead end.
So you know what they say, once you eliminate the impossible, whatever remains, however improbable, must be the truth. Let's see what's left standing.
And here it is, the last suspect in the lineup. The price of the bond is higher than 1.15 shekels. Now, this might seem almost too simple, but let's break down why this is the only answer that has to be true.
This is where it all comes together. Remember our calculation? We proved with math that the bond price must be greater than 1.2333. So, if a number is definitely bigger than 1.2333, isn't it also, by definition, bigger than 1.15? Of course it is. It's pure logic. This is the only statement that our evidence backs up 100%. Case closed.
So, we've solved the riddle.
But it leaves you with a really interesting thought, doesn't it? We didn't need some supercomputer or a crazy complex algorithm to figure this out. All it took was understanding one core principle of market efficiency. And it makes you wonder, what other hidden values are just sitting there in complex securities waiting to be uncovered by simple, solid logic?